Hello and welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamilton, and today we have a lot to cover about the latest developments in the mortgage and real estate market here in Ontario. From interest rate changes to inflation trends, we will dive into the key stories that could impact your financial decisions. So, let us get started. First up, we need to talk about the growing speculation around the Bank of Canada's next move. Economists and market watchers are betting that the Bank of Canada will deliver another interest rate cut this week. This expectation has been building ever since last week's release of the latest Statistics Canada inflation report, which showed that annual inflation cooled to 2.7% in June. This was slightly lower than the 2.8% that markets had been expecting. The inflation reading has bolstered market confidence that the Bank of Canada might be poised for a second rate cut on top of the 25 basis point cut it announced just last month. To put this into perspective, last month's interest rate cut reduced the central bank's key rate from 5% to 4.75%. This was the first rate cut we have seen in more than 4 years. Royce Mendez, managing director and head of macro strategy at Desjardins, weighed in on this, saying, "I think it's very likely the Bank of Canada cuts rates again next week. It wouldn't really make sense from a strategic point of view to only cut rates 25 basis points and then leave them there and see how the economy responds, because that wouldn't really cause a lot of change in the trajectory of the economy or inflation." Mendez added that it has always made sense that the Bank of Canada was likely going to do at least 2 rate cuts in a row before pausing. And now, recent data has reinforced that view. In addition to the latest inflation report, Mendez noted that recent data showing rising unemployment as well as subdued expectations for growth by Canadian businesses all support the prospect of another cut. While inflation remains higher than the Bank of Canada's 2% target, Mendez believes delaying any longer could have negative repercussions. He mentioned, "The interest rates at the levels they are currently are actually very restrictive. You can see it in consumer spending trends. You can see it in the housing market. I would say if the Bank of Canada didn't cut next week, it would signal a much greater willingness to tip the economy into recession, just for the sake of getting inflation down a few tenths of a percentage point more." The latest Statistics Canada report on retail sales last Friday showed Canadians reined in their spending in May as retail sales dropped 0.8% to $66.1 billion. Sales were lower in 8 of the 9 subsectors tracked by the agency. Mendez explained that what the Bank of Canada is trying to do is just reduce the amount of restraint it is placing on the economy. It is not trying to stimulate the economy, but simply trying to reduce the amount of headwinds it is providing. He added that a second rate cut could make Canadian consumers begin to feel more confident about spending again. The most recent data on the Canadian job market shows the economy stalling in June, losing 1,400 jobs, while the unemployment rate rose to 6.4% from 6.2% in May. The June result was the highest reading for the unemployment rate since January 2022, another indication that raises the odds of the Bank of Canada lowering rates this week. However, not everyone is convinced that an interest rate cut is a done deal. Clay Jarvis, a mortgage and real estate expert for NerdWallet Canada, said this week's decision could go either way. Considering how cautious the bank is, reducing the overnight rate when inflation is still well over 2% would be fairly uncharacteristic, Jarvis said in a note. If the cut does happen, Jarvis believes that shaving 25 basis points off of variable interest rates is unlikely to be enough to shake up Canada's housing market significantly, as buyers grapple with the prospect of higher mortgage payments. A survey conducted by CPA Canada and BDO Debt Solutions shortly after the June rate cut found that half of Canadians say interest rate hikes have negatively impacted their debt loads, with 7 out of 10 saying the June cut had no impact on their financial outlook. The survey also found that 52% of respondents believe continued interest rate cuts will not go far enough to reduce the financial strain. Canada's inflation rate fell more than expected in June, boosting the likelihood that the Bank of Canada will cut interest rates again next week. The Consumer Price Index rose by an annual 2.7% in June, down from 2.9% in May, Statistics Canada said Tuesday in a report. Financial analysts were expecting an inflation rate of 2.8%. The drop was largely due to softer growth in gas prices, while core inflation measures were marginally down, Matt Lundy reports. It also means that the annual inflation rate has been within the central bank's target range of 1% to 3% for 6 consecutive months. All eyes are now on the Bank of Canada, which announces its next policy rate decision on July 24th. Earlier this week, a global tech outage wreaked havoc on computer systems around the world. It grounded flights, forced broadcasters off the air, and disrupted services in multiple sectors, from banking to healthcare to railways. A software update from global cybersecurity company CrowdStrike appeared to trigger the system problems, affecting customers using Microsoft's Windows operating system. Toronto-based Porter Airlines canceled all Friday flights until 3 p.m. Eastern Time and Toronto Dominion Bank experienced service interruptions to its web broker online trading platform. University Health Network also said some of its systems had been affected by the outage. Microsoft later said on Friday that the issue had been fixed, but residual impacts continued to affect some services. Shipping costs are rising again. According to an index of 8 major shipping routes from maritime consultancy Drewry, freight rates have soared by 257% this year. For example, from Shanghai to Los Angeles, the rate for shipping a 40-foot container is roughly $7,300 United States dollars. That is up from $1,965 United States dollars a year ago. The rise in shipping costs has been attributed to a variety of factors, including a boost in demand for discounted Chinese products and ships having to take longer routes because of conflict in the Red Sea. The good news, though, is that costs are still well below the peak levels of 2021. Matt Lundy takes a closer look at the figures in this week's Decoder. Rich Kruger was lured out of retirement in early 2023 to take over as the head of Suncor, and he has been ruffling political feathers ever since. About 5 months into the job, he said on an earnings call that the company had spent a disproportionate emphasis on the longer-term energy transition. He said it needed to revise its direction toward the immediate financial opportunities in the oil sands. Those comments became something of a political football between Ottawa and Alberta. Emma Graney sat down with Mr. Kruger recently to get his take on the politics of oil and gas and talk about where Suncor goes from here, including the future of its oil sands base plant site north of Fort McMurray, Alberta. In other news, all of Canada's major grocers have now agreed to sign on to a grocery code of conduct after years of contentious negotiations. Costco Canada and Walmart Canada agreed to participate in the new rules, which are designed to improve fair dealings in the industry, especially between big grocers and their suppliers. Their agreements follow Canada's largest grocer, Loblaw Companies Limited, which also dropped its earlier opposition to the code in May. The new code is expected to be implemented by June of next year. As Susan Krasinski-Robertson reports, it is unlikely to provide any relief to Canadians still reeling from significant increases in grocery prices, but instead provide more economic certainty for suppliers. Borrowing costs may still be uncomfortably high for most Canadians, but anyone venturing into the mortgage market this summer will find a welcome silver lining, a growing variety of lenders and brokers vying to offer the lowest rates and the slickest user experience. The Globe tested 5 websites: Nesto, Perch, Pine, Wowa.ca, and RateHub.ca, in a head-to-head comparison to help prospective homebuyers and homeowners with upcoming mortgage renewals navigate the sea of choices. Here is a look at the findings. Last week was a busy one for mortgage-related news and rates. Our banking regulator provided its latest review of its residential mortgage underwriting guidelines. We received updated Consumer Price Index data for September, and the Bank of Canada released both its Q3 Business Outlook Survey and Canadian Survey of Consumer Expectations results. I will offer my take on each and then close with a look ahead at the Bank of Canada's meeting this Wednesday. Last week, our banking regulator, the Office of the Superintendent of Financial Institutions, provided the much-anticipated review of its mortgage underwriting guidelines. There was concern that the regulator would follow through on its previously outlined plans to tighten lending standards and heap further suffering on our already cooling real estate markets. But it held off on making material changes. For now, the regulator will allow market forces to play out, satisfied that demand for mortgages has cooled while mortgage default rates remain at the low end of their historical range. There was hope that the regulator would finally end an anti-competitive practice. That did not happen either. The regulator has been under steadily increasing pressure to allow renewing borrowers to switch lenders at renewal without having to requalify at the mortgage qualifying rate, which is in the 8% range today. Borrowers who paid for high-ratio default insurance can be qualified using their actual rate at renewal if they decide to switch lenders, but they are a small subset of the total. The regulator's requalification requirement for most renewing borrowers is trapping an increasing number of them with their current lenders, forcing many to accept uncompetitive rates. The regulator's rationale was that the existing lender did extensive due diligence when providing the initial loan, typically 5 years ago, and that a new lender should apply the same standards at renewal to avoid competing for loans that do not meet the regulator's expectations. Practically speaking, this means the regulator prefers to have lenders renew their existing borrowers with no re-underwriting or stress testing at comparatively higher rates, rather than allow competing lenders to fully re-underwrite applications using their most competitive contract rates. If it were your money on the line, which group of borrowers would you rather lend it to? Bluntly put, our banking regulator's decision to maintain this anti-competitive restriction and its failure to provide sufficient justification for doing so is hurting an increasingly large number of Canadians. This is, in a word, inexcusable. Last Tuesday, Statistics Canada confirmed that our headline, Consumer Price Index decreased from 4% in August to 3.8% in September, lower than the consensus forecast of no change. Core Consumer Price Index, which strips out volatile food and energy costs, also fell from 3.6% in August to 3.2% in September. Statistics Canada noted that the deceleration in prices was broad-based, with notable declines in durable goods, groceries, and travel-related services. Gas prices rose by 7.5% year-over-year last month, but have cooled since. Financial markets responded by reducing the odds of a Bank of Canada rate hike this week to about 15%. That said, the bond futures market is still pricing in a 50% chance that the bank will hike one more time before the end of this tightening cycle. Last week, in his presentation at the National Mortgage Professionals Canada Conference, CIBC Deputy Chief Economist Benjamin Tal explained that our overall consumer price index would already be back to 2% if interest rate payments were excluded. He believes that fact should compel the Bank of Canada not to hike again and to start cutting its policy rate sooner than is generally expected. I do not think the bank shares that view. Interest rate increases and price rises are fighting for the same dollars. Without today's higher interest rates, other prices would not have cooled to the same extent. From an overall inflation perspective, it is one or the other, and as such, the fact that overall inflation remains elevated matters much more to the Bank of Canada than where specific current price pressure is coming from. Higher rates also needed to be fully accounted for because they feed into consumer and business inflation expectations. The growing belief that inflation will remain higher for longer is fueling behavior changes that are inflationary and can become self-reinforcing, such as when workers demand more pay to compensate for higher perceived future inflation. If the Bank of Canada were concerned that inflation expectations were becoming unmoored from its 2% target, the latest survey of consumer expectations results should make them more so. The bank noted that consumer inflation expectations remain stubbornly high and that the gap between perceptions of inflation and actual inflation is unusually wide. Consumers expect inflation to cool over the next 12 months, but their expectations for inflation 2 years hence increased in Q3. On average, they do not believe that inflation will return to the bank's 2% target over the next 5 years. Signs of continued confidence in the labor market were also evident. Workers expressed a higher than normal likelihood of voluntarily leaving their job, which is a sign of confidence in the demand for their services. Wage growth expectations are now the highest they have been since the bank started sending out this survey in 2014. Workers also expect that higher prices will cause their spending to increase faster than their incomes. If they believe that inflation will outpace their current earnings, and if they are confident in their job prospects should they decide to change employers, it is reasonable to infer that workers will continue to push for compensation increases, which will then feed into future prices. The Q3 Business Outlook survey revealed that businesses are becoming more cautious in their outlooks. On average, they reported that economic activity has slowed across a broad range of indicators. Most businesses are anticipating that sales will slow, and as such, they are planning less investment in capacity expansion. More than half of the businesses surveyed expect to continue increasing their prices by more than normal over the next 12 months. About half of them believe that the impacts from the bank's tighter monetary policy are just beginning. Many expect growth and demand to continue to be subdued. Interestingly, while businesses expect to slow their pace of hiring, few are planning layoffs. Most expect higher than normal wage increases over the next year. Many businesses also remain uncertain about when their wage growth will return to normal. Wages are expected to increase by an average of about 4% over the next 12 months, compared with an average of 5% year over year in August. When it comes to labor costs, most businesses sounded more like price takers than price makers. Continued price hikes seem likely to be defensive to account for higher input costs rather than offensive to increase profit margins. Overall, inflation expectations edged down somewhat. About half of the businesses surveyed still expect that inflation will average more than 3% over the next 2 years. But roughly one-third of firms still believe it could take longer than 3 years before inflation returns to the bank's 2% target. I expect the Bank of Canada to hold steady when it meets this week, and to reiterate its commitment to continue raising its policy rate if circumstances warrant. There is clear evidence that the 10 rate hikes the bank has already made this cycle are still increasing their bite. Our GDP growth has slowed to stall speed. An increasing number of consumers have now depleted the pandemic savings they were using to maintain spending in the face of higher prices, and higher bond yields have slowed housing market activity to a crawl. But all that said, consumer inflation expectations remain stubbornly high. Wage growth is still robust, and falling productivity rates are less likely to reverse, while businesses are planning to reduce investment over the near term. The bank will also want to ensure that its guidance is hawkish enough to prevent overly enthusiastic reactions that would undermine its goal of reducing near-term demand. Put me down for a hawkish hold. Put me down for a hawkish. If you are in the market for a mortgage today, I continue to believe that the two most compelling choices are between a 3-year fixed rate and a 5-year variable rate. A 3-year fixed rate term offers the best risk-reward balance among today's fixed rate options. The premium you pay over 5-year fixed rates is now down to about 0.35%. I would be reluctant to lock in for longer than 3 years when rates are at their highest levels in more than a decade and appear to be near their peak. The premiums for shorter-term fixed rates are much higher. The shorter the term, the greater the risk that you will be renewing before rates have fallen enough to leave you better off. If you can tolerate the risk that your variable mortgage rates may go still higher from here before they drop, and if you are prepared for elevated levels for another year or more, choosing a 5-year variable rate today has the greatest potential for saving over the full term of your mortgage. In fact, at this point, given we are at or near the peak in rates, and that 3-year fixed rates and 5-year variable rates are about the same, the case for variable rate options is becoming more compelling all the time. In isolation, last week's lower-than-expected consumer price index data should have pulled down Government of Canada bond yields. That did not happen. Instead, they were pulled higher by their United States Treasury equivalents, which were buoyed by the release of stronger-than-expected United States retail sales data. This is a manifestation of my recent warning that the concomitant relationship between Government of Canada bond yields and United States Treasuries means that our bond yields, and by association our fixed mortgage rates, will likely remain above the levels that would be appropriate if they were solely a reflection of our weakening domestic economy. Our variable mortgage rates, on the other hand, will not be similarly tethered. They move up and down with the Bank of Canada's policy rate, which will more closely reflect our domestic conditions. Put more simply, variable mortgage rates will fall when Canadian inflation cools sufficiently, whereas our fixed mortgage rates may have to wait until United States inflation does the same. Given the current divergence in our economic trajectories, I think the former is likely to happen sooner than the latter. Now, let us turn our attention to the latest data on housing starts for June and the first half of 2024. According to the Canada Mortgage and Housing Corporation, the total monthly seasonally adjusted annual rate, or SAR, of housing starts for all areas in Canada decreased by 9% in June compared to May. This translates to 241,672 units in June, down from 264,929 units in May. The 6-month trend in housing starts also saw a slight decline, dropping 0.4% from 248,260 units in May to 247,205 units in June. The trend measure is a 6-month moving average of the SAR of total housing starts for all areas in Canada, providing a clearer picture of the market by smoothing out monthly fluctuations. When we look at the actual number of housing starts across Canada, in urban centers with populations of 10,000 or more, the figures are even more telling. There was a 13% decrease in June, with 20,509 units started, compared to 23,518 units in June 2023. This year-over-year decrease was driven primarily by a 16% drop in multi-unit starts, while single detached starts remained relatively stable. June's total actual housing starts were markedly lower in 2 of Canada's 3 major cities compared to June 2023. Toronto saw a staggering 60% decline, and Vancouver was down 55%. Both cities recorded significant drops in multi-unit construction. On the other hand, Montreal bucked the trend with a 226% increase, largely due to a surge in multi-unit activity. For the first half of 2024, Canada's 6 largest census metropolitan areas experienced a modest 4% combined year-over-year increase, driven by higher starts levels in Calgary, Edmonton, and Montreal, which offset decreases in Vancouver, Toronto, and Ottawa. Among these major centers, Vancouver and Toronto have seen apartment starts slow as high interest rates and weak condominium pre-construction sales appear to be affecting these markets negatively. Conversely, Montreal has observed higher multi-unit construction this year, with apartment starts up 63% from the 8-year low recorded in 2023. Calgary and Edmonton also saw higher construction activity across all dwelling types, driving total starts up by 38% and 67% respectively. Bob Dugan, the chief economist at the Canada Mortgage and Housing Corporation, commented on these trends, stating, "The higher interest rate environment appears to have caught up with some of Canada's major centres, as lower multi-unit starts, particularly in Vancouver and Toronto, drove both the SAR and trend down in June. While strong starts growth in June and the first half of 2024 in Calgary, Edmonton, and Montreal mitigated some of these decreases, we expect continued downward starts pressure across Canada throughout 2024. In summary, the monthly SAR of total urban housing starts, which includes centers with populations above 10,000, was 9% lower, with 223,234 units recorded. Multi-unit urban starts decreased by 12% to 180,205 units, while single-detached urban starts saw a 2% increase to 43,029 units. The rural starts monthly SAR estimate stood at 18,438 units. Montreal saw a 23% increase in total SAR housing starts, driven by a 26% rise in multi-unit starts. Vancouver experienced a 13% decline, largely due to decreases in multi-unit starts, and Toronto saw a 37% drop, also primarily in the multi-unit segment. As always, the Canada Mortgage and Housing Corporation provides unbiased housing-related data, research, and market information to help close knowledge gaps and deepen understanding of complex housing issues. Their data facilitates the analysis of monthly, quarterly, and year-over-year activity in the new home market, helping to inform future policy decisions. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found this information useful as you navigate the ever-changing landscape of the mortgage and real estate markets. Stay tuned for more updates and insights in our next episode. Until then, take care and stay informed.